This is exercise 2-3A in your textbook, and we're taking a look at the effects of transactions for balance sheet accounts only on the accounting equation. So keep in mind when we talk about balance sheet accounts, we're talking about assets, liabilities, and owner's equity, which is what you see here in the green ribbon. So the answers are here as you can see, but I want to go through and explain to you where the answers came from. This will help you with your 3B. And every time you input information, all you have to do is put in the gray fields where necessary, and then everything else will automatically calculate. So for transaction A, it said that we invested cash into the business. So we know at this point that we have cash because we put cash into the business. Cash is an asset. And if we put it into the business, that means we deposited it. So we are going to increase our assets by $27,000. And any time that you invest money into your business, it also increases your owner's equity. So we put the 27 here and the 27 here. And you'll notice this equation, assets equal liabilities plus owner's equity. So we have to ensure that for every single transaction, this is true. So 27,000 equals 0 plus 27,000. And then it automatically calculates our new balances in each of those categories. So B then says that we bought office equipment on account. So we bought office equipment. We now have office equipment because we bought it. And office equipment is an asset. So we're going to increase our assets by $7,500. And then you have to ask yourself, how did I pay for it? Well, if I bought it on account, I didn't give them cash, did I? No. So I owe them money. That's what it means when we say on account. So that's a liability since I owe somebody something. So the other $7,500 goes here, and then you can see the accounting equation for transaction B is equal. $7,500 equals $7,500 plus 0. And then when it also balance here, it's going to be equal. Now the full equation, $34,500 equals $7,500 plus $2,700. Then in transaction C, we bought some office equipment again, but this time we paid cash for it. So office equipment and cash are both assets. So what's happening in this scenario is we're exchanging one asset for another. So we are decreasing our asset cash, but then we're increasing our asset office equipment. So what happens is technically these cancel each other out, so you really have 0 equals 0 plus 0. And then our balance also remains balanced. And then on D it says that we paid cash on account to supplier in transaction B. So if you remember up here on B, that's when we originally bought our asset, but we didn't pay them, we owe them. Well, now we're going to make a payment on it. So if you're going to make a payment on it, you're going to use cash to do that. So you're going to decrease your cash by $2,300, which is an asset. And then if you pay somebody that you owe money to, you're not going to owe them the full $7,500 anymore. So we're going to decrease the amount that we owe them because we made a payment. If you owe somebody $5 and you pay them $5, you don't owe them anything anymore. So we owed $7,500, we're going to pay $2,300, so now we're going to only owe $5,200. So after this transaction, everything balances. Total assets, $32,200 equals total liabilities of $5,200 plus total owner's equity of $2,700.